For years, luxury felt like a locked room, exclusive, pricey, and unattainable. But today, that room is cracking open. 9 major luxury brands are seriously struggling right now, not because customers left, but because they overpriced themselves out of relevance. These brands once charged $1,500 to $8,000 for bags, shoes, and accessories. Now, sales have dropped by 30% to 60% in some cases. The markup that once signaled prestige now smells of greed. Shoppers aren't blind. They see that the quality doesn't match the outrageous price. They see better alternatives at lower costs, and they walk away. As the real numbers leak, revenue falling, discount events rising, and brand value slipping, the illusion of luxury starts to crack. In this video, we'll spotlight each of those 9 struggling brands, analyze the data behind their decline, and break down how overpriced tags and overconfidence pushed them to the edge. Then we'll explain why luxury no longer means what it used to. Let's jump right in. Number 9. Gucci. Gucci's slide in 2025 has been sharp and measurable. In the first half of 2025, the house recorded about 3 billion euros in revenue, down 26% year-on-year. Sales in Gucci's own stores fell about 24% on a like-for-like basis, while wholesale revenue plunged about 42%, meaning department stores and multi-brand shops bought far less Gucci product. The house's recurring operating income dropped from roughly 1 billion euros the year before to 486 million euros in the first half of 2025, a fall of roughly 50%. Why did this happen? One big reason was a loss of fashion momentum. Gucci changed creative directions several times in recent years. Those changes made some seasons feel disconnected from what longtime buyers expected. When a brand like Gucci loses a clear, strong fashion story, buyers stop buying as often. Stores that used to sell out now hold more carryovers. Some new items sold well, but not enough to replace lost hits. Analysts and trade press wrote that this weak creative pull cost Gucci repeat customers and cultural buzz. A second reason was price pressure. After the pandemic, many luxury houses raised prices a lot. Gucci's prices became very high across bags, shoes, and ready-to-wear. When shoppers began to look closely at value, many felt the price did not match the product story or craftsmanship in every case. This is especially true for younger buyers and for tourists who compare prices across markets. As a result, full-price sell-through slowed in several regions, and some customers waited for discounts or looked elsewhere. Regional demand also changed. Kering's figures showed weaker sales in several key places. Asia Pacific and Japan had notable drops, and tourist activity did not return fully to previous levels. Lower tourist traffic in cities that used to bring luxury shoppers meant fewer big purchases in store. Wholesale weakness magnified this. With fewer products in multi-brand stores, Gucci lost a path to new customers. Retail footfall fell in some stores, and that reduced impulse buys of high-value items. Gucci's size makes its problems a group risk. Because Gucci accounted for a large share of Kering's profit, the brand's decline pulled down the whole group's results. Kering's management must now balance rebuilding Gucci while stabilizing other houses. Fixes will need clearer creative leadership, more careful price moves that match perceived value, and stronger wholesale and tourist strategies. Without those steps, sales and margins may stay under pressure for more quarters. Up next is a brand that priced itself out of loyalty. Now its customers are walking away, refusing to pay for just the logo. Number 8. Louis Vuitton. Louis Vuitton is the crown jewel inside a larger division. In the first half of 2025, LVMH reported 39.8 billion euros in group revenue. The group's fashion and leather goods division, which is where Louis Vuitton sits, showed a clear slowdown in the period. Multiple reports and LVMH's own statements described the division as the most hit line of business. Organic sales for fashion and leather goods fell materially, in some measures by high single digits to low double digits in recent quarters, which trimmed group growth and reduced operating profit. The reasons behind the drop are broad and partly different from the issues at any single house. One core factor was shifting buyer behavior. After years of price increases, many consumers grew less keen on obvious logo goods. They looked for different values, more minimalistic branding, or goods that told a clearer craft story. This change hit big leather goods and visible logo categories hardest. LVMH noted weaker tourist spending in several markets. Fewer tourists in luxury hubs meant fewer big buys of suitcases, bags, and high-end leather pieces. Another factor was product mix and novelty. Luxury sales often depend on frequent hits, a new bag, a fresh capsule, or a surprise collaboration that makes customers rush to buy. In 2024 to 2025, some categories were less novel and some collections felt overexposed after big runs. That lowered the urgency to buy now and pushed more inventory toward discount risk or slower turnover. The net effect was slower same-store sales and pressure on full-price margins. Trade press singled out that the fashion and leather goods division had its steepest slowdown among all LVMH divisions in mid-2025. Meanwhile, LVMH called out weaker demand in the United States and China and noted that geopolitical and trade tensions could unsettle supply and price planning. The company used tactical moves like considering local production increases and selective pricing to protect margins and adapt to possible tariffs. The group also pointed to beauty and selective retail as pockets of strength that helped buffer the overall decline. But the heavy weight of fashion and leather goods means any weakness there has a strong effect on group profit. Operationally, the result was lower store traffic in some markets and fewer large purchases. Louis Vuitton still performed relatively well compared to some peers, but the combined division effect meant the fashion group profit fell and investor sentiment cooled. LVMH is moving to protect margins, focus on creativity, and adapt production to be closer to key markets. However, the mid-2025 numbers show even the market leader must work hard to restore previous growth rates. Next is a brand that counted on price to build prestige, only to find that overpricing finally turned its own reputation into a burden. Number 7. Burberry. Burberry's recent results show a serious drop after years of being a strong luxury name. For the 12 months ending 29 March 2025, Burberry reported a pre-tax loss of £66 million, a sharp reversal from the £383 million profit recorded the previous year. This swing reflects deep problems as revenue fell from £2.97 billion in 2024 to about £2.46 billion in 2025, a drop of around 17%. According to the company's 2025 preliminary report, gross margin shrank as the firm tried to clear excess inventory, and adjusted operating profit collapsed to just £26 million, compared with £418 million the year before. The adjusted operating margin sank from 14.1% in the prior period to roughly 1%. These numbers show Burberry is losing both scale and profitability at once. Several underlying causes explain Burberry's slump. One major factor is a broad slowdown in global luxury demand. In its 2024 financial year results, year ended March 2024, Burberry's profit had already dropped 40%, with second-half sales down 8% compared with the prior year. The weakness hit hardest in the Americas and in parts of Asia, regions that once helped drive international luxury sales. This softening demand continued into 2025, making the full year worse. Another problem is overextension and brand positioning. Burberry tried to move upmarket. It expanded beyond its classic trench coats and outerwear and pushed fashion, leather goods, and broader collections. But this move diluted its identity. As demand shrank, many items failed to sell at full price, forcing markdowns or inventory exits. Indeed, in the 2025 results, Burberry mentions that part of the margin hit was due to inventory exit to address the overhang. That means they sold goods at discounts or wrote down excess stock, a clear sign that supply had outpaced demand. In response, new CEO Joshua Schulman, who was appointed in mid-2024, launched a bold restructuring plan. The company announced plans to cut roughly 1,700 jobs globally by 2027, representing about 18 to 20% of its workforce. That includes shutting down the night shift at its trench coat factory in Castleford and reductions among store and office staff worldwide. The plan aims to save an additional £60 million on top of earlier cost cuts and restore financial health. Alongside cost-cutting, Schulman said Burberry will refocus on its heritage pieces, core outerwear, classic coats, and its signature check scarves, and scale back the size of collections. The goal is to bring back clarity to the brand image and reconnect with customers who value timeless British luxury rather than pursue mass-market fashion hype. If the restructuring and refocusing work, Burberry could stabilize, but the 2025 data reveal a brand far from the strong, steady performer it once was. Here comes a brand that sold exclusivity and status, but after years of steep prices, status couldn't save it from falling behind. Number 6. Chanel. Chanel's 2024 financial results exposed a sharp slowdown at one of the world's biggest luxury houses. The company reported global revenue of $18.7 billion, a 4.3% decline compared with 2023. Operating profit fell by 30%, falling from prior year levels to about $4.48 billion. For a brand used to double-digit growth through the post-pandemic luxury boom, this marks a stark reversal. Meanwhile, net profit reportedly dropped about 28.2% to roughly $3.4 billion. Why did Chanel, an ultra-luxury stalwart, stumble like that? One major cause was weakening demand in key markets, especially Asia and the Americas. Sales in the Asia-Pacific region fell sharply. Reports suggest around a 7.1% drop in the region that includes China, while the Americas also saw declines. As these regions together have often driven a large share of Chanel's growth, the drop translated quickly into weaker top-line numbers. At the same time, Chanel maintained a high level of investment during the downturn. In 2024, the company spent approximately $1.8 billion on capital expenditures, a 43% increase compared to 2023. This spending went into boutique expansion, real estate purchases, including flagship store properties, and upgrading supply chain capabilities. The idea was to position Chanel for long-term strength, better stores, stronger infrastructure, and readiness for future growth. But that heavy investment came at the cost of current profitability. Many analysts argue the timing was risky as they were investing big while sales were falling, and that the generous pricing strategy, which Chanel has long used, became harder to justify when global economic uncertainty and consumer caution rose. Part of the problem also appears to be price fatigue. Over recent years, Chanel has raised prices on many of its iconic items, including bags and leather goods. For example, some classic handbags now cost more than double what they fetched a few years ago. As prices rose, some aspirational buyers and younger customers who might once have aspired to own a Chanel piece found the cost too high or judged the value-to-price ratio as poor. As a result, fewer new buyers entered at lower price tiers, and some older customers may have delayed or skipped purchases, weighing on volume and brand reach. Yet Chanel's management appears committed to long-term positioning over short-term gains. CEO Lena Nair said the company sees luxury as cyclical and that fluctuations are part of a long view. The heavy investment in stores, experience, and supply chain aims to ensure that when markets return, Chanel is well-placed to deliver premium product, service, and brand strength. But as of 2024, the house looks less immune than before. Even a top-tier luxury brand is not safe from changing markets, price sensitivity, and softer global demand. For Chanel, the path forward may require balancing its classic exclusivity with more sensitivity to demand trends, possibly slower price increases, more diverse product mixes, and careful investment pacing. The 2024 results make clear that even what seems like recession-proof luxury can stumble if global conditions and consumer attitudes shift. Number 5 is a brand that once stood tall on the heels of bold price tags. Now those same tags feel like weights pulling it down as customers abandon it for realism. Number 5. Versace. Versace's recent performance under Capri Holdings has worsened sharply. In the full-year fiscal 2025, Capri Holdings' overall results showed a drop in revenue across its brands. For Versace, the decline has been steep. In the fourth quarter alone, Versace's revenue fell by 21.2% and 19.7% on a constant currency basis relative to the prior year. The gross margin remained roughly around 65.4%, slightly up from 64.8% the prior year, but this was overshadowed by a dramatic swing in profitability as Versace recorded an operating loss of $13 million, meaning the operating margin turned negative, about negative 6.3%, compared with a slim profit in the prior year. The sharp drop in sales, compounded with fixed costs and lower sell-through, turned the business unprofitable. These quarterly results reflect a longer pattern. Earlier in 2025, during the second quarter, Versace revenue was down 28.2%, with retail sales falling high teens and wholesale revenue decreasing double digits. The Americas region saw a 33% revenue decline, while EMEA dropped 28% and Asia also declined about 20%. Operating loss in that quarter was already negative, around $3 million. The persistent drop across all major geographic regions shows that Versace's decline was not limited to one market. One reason this is happening appears to be a broad pullback in consumer demand for mid to upper luxury brands. As global economic uncertainty increases, many consumers are cutting down on high-end discretionary spending. Versace, with its bold, fashion-heavy image, may have found fewer buyers willing to pay premium prices in a cautious market. According to coverage in industry media, the entire Capri portfolio suffered from softening consumer demand. Another issue is overexposure and diluted brand identity under Capri's management. Versace's attempts to push volumes through wholesale channels appear to have backfired. With wholesale revenue declining double digits during several quarters, the brand lost both profitability and exclusivity. Wholesale and retail traffic both dropped, meaning the brand had less control over presentation and pricing, perhaps undermining the luxury appeal consumers expect from Versace. Also, the structural changes around Versace reflect its troubled state. In April 2025, Capri Holdings announced a deal to sell Versace to Prada Group for roughly $1.4 billion in cash. The transaction, expected to close in the second half of calendar 2025, will result in Versace being classified as a discontinued operation in Capri's future accounts. This sale underlines that Capri itself sees Versace as a brand too weak or too costly to salvage within its current structure. In short, Versace's fall stems from plunging revenues, losses on operations, weak geographic demand, poor wholesale and retail execution, rising inventory burden, and a faded brand momentum, all culminating in its sale. After years under a major global parent, the brand now needs reinvention under new ownership, or it risks losing what once made it a top-tier luxury name. Coming up is a brand whose luxury label stopped meaning elegance. Instead, it became a flashing sign for overpriced status nobody wanted to pay for anymore. Number 4. Michael Kors. Michael Kors has long been a staple in accessible luxury and aspirational fashion. However, it's now faced with sustained headwinds through 2024 and 2025. In the 2025 fourth quarter alone, Michael Kors' revenue dropped 15.6% compared with the prior year. Gross profit fell, and gross margin shrank to roughly 59%, down from 60.8% prior year. Operating income tumbled, resulting in a slim operating margin of just 4.6%, down sharply from 14.1% in the prior year. The revenue decline was broad-based. In third quarter fiscal 2025, the quarter before, Michael Kors' revenue had already dropped about 12.1%, 11.7% in constant currency. Retail sales declined low teens while wholesale dropped high single digits. Region-wise, America's revenue fell about 10%, EMEA dropped 13%, and Asia plunged around 27%. That shows that no major region escaped the downturn. Global demand just weakened. One big factor influencing this slump seems to be changing consumer behavior and market conditions. As living costs rise and economic crisis spreads, many consumers abandon aspirational luxury purchases. Michael Kors, positioned between fast fashion and high luxury, may have suffered from being neither cheap enough nor prestigious enough, making it vulnerable when shoppers tighten budgets. Industry reports describing Capri's overall decline note that many consumers pulled back from high-priced fashion. Another factor is lowered full-price sell-through and weaker brand desirability. As discounts and outlet sales increase to clear inventory, the brand's perceived value likely weakened. When customers expect markdowns, they may wait rather than pay full price. That hurts margins and reduces urgency. Capri's own report for fourth quarter 2025 noted loss from operations and negative consolidated margins, showing that lower price realization and fixed costs combined badly. There is also a structural burden. In fiscal 2025, Capri recorded a large non-cash tax valuation allowance, $545 million globally, part of which related to Versace. While not wholly Michael Kors's fault, this write-down impacted the group's net results and led to a reported net loss of $645 million, or negative $5.44 per diluted share, which weighs on investor confidence and financial flexibility. Overall, the broader environment around Capri Holdings, with multiple underperforming brands, including Versace and Jimmy Choo, meant resources and attention were stretched. Capri's full-year revenue decreased 15.4% on a reported basis, and adjusted operating margin turned negative 3.2%. That group-wide weakness constrained support for Michael Kors, especially for marketing, product innovation, or expansion. In response, Capri leadership says they are re-evaluating strategic initiatives to try to improve sales trends. But as of 2025, Michael Kors looks caught between consumer pullback, brand value erosion, and industry-wide luxury slowdown. Unless the brand repositions carefully, maybe focusing more on value, reinvigorating design appeal, and balancing price versus demand, its road to recovery may be long and shaky. And brand number 3, it demanded high prices for every stitch. Yet now those high demands are pushing buyers toward brands that deliver value instead of a name. Number 3, Jimmy Choo. Jimmy Choo has seen its business under growing stress in fiscal 2025. In the third quarter, the brand reported revenue of $159 million, down 4.2% compared to the same quarter a year earlier. Retail sales held roughly flat, but wholesale revenues dropped by mid-teens, showing that department stores and multi-brand retailers sharply cut orders or purchases. Geographic breakdown indicates the Americas saw a 10% drop in revenue, Asia declined 17%, while EMEA, Europe, Middle East, and Africa saw a modest 9% increase. Despite a slightly growing global customer database, these declines translated into a negative result. Jimmy Choo posted an operating loss of $6 million, with an operating margin of negative 3.8%, compared with a modest profit the prior year. The drop came amid decreased full-price sell-through and weaker demand overall. The broader context around Capri's performance deepens the challenge for Jimmy Choo. In third quarter 2025, Capri's total revenue fell 11.6% year-on-year, and gross margins shrank slightly. Gross margin fell from approximately 65% to 64.4%, driven largely by lower full-price sales. Lower margins and revenue meant Capri took a heavy non-cash impairment charge, pushing group operating losses deep and pulling down resources that might have supported Jimmy Choo. Several structural issues hurt Jimmy Choo. Demand for high-end shoes and accessories weakened globally as many consumers cut back on discretionary spending. For aspirational or mid-luxury buyers, which is a core Jimmy Choo customer base, rising costs of living and economic uncertainty have reduced appetite for pricey fashion items. At the same time, wholesale channels, which often serve lower price point buyers or discounter customers, have pulled back sharply, limiting Jimmy Choo's volume reach and forcing the brand to rely more heavily on full-price retail, precisely where consumer caution is highest. Industry observers have described this as a softening consumer demand hitting accessible luxury players especially hard. Moreover, the macro environment has amplified these challenges. trade tariff pressures and global inflation have squeezed margins and increased costs for worldwide luxury firms. Capri itself acknowledged that lower full-price sell-through and expense deleverage drove margin pressure across its brands. For Jimmy Choo, which already had tighter margins than ultra-luxury houses, this combination was particularly damaging. Capri's management appears aware of the problem and has indicated a strategic shift. Leadership has suggested refocusing efforts on its two main brands, one of them being Jimmy Choo. The hope is that by narrowing focus, reducing costs, and perhaps rethinking distribution and product mix, Jimmy Choo may stabilize and return to growth. For the brand to recover, it would need to reevaluate its product and price positioning to match shifting consumer affordability and desire. Next comes a brand that once rode the hype of high tags. Now those tags feel heavy, pushing buyers towards smarter, cheaper alternatives. Number 2. Dior. Dior has not escaped the widespread slowdown affecting fashion and leather goods houses in 2025. In LVMH's first half 2025 results, the group's fashion and leather goods division, where Dior operates, reported a revenue decline of 8% year-on-year. The second quarter alone saw a 9% drop in organic sales for the division. That decline marked the steepest among all of LVMH's business lines. These broad numbers strongly suggest that Dior's own leather goods and fashion lines suffered significant setbacks. Several market dynamics contributed to Dior's slump. First, demand weakened across multiple key geographies like Asia, especially China and other Asia-Pacific markets, saw soft luxury consumption, undercutting what had been a major growth engine for high-end European brands. Tourism flows, which once pumped luxury purchases in destinations like Japan, also dropped significantly, reducing transient tourist buying that had helped sustain luxury turnover. Second, there is a broader shift in consumer mindset. Many buyers, especially younger consumers and those newly entering luxury, are growing more selective. They are less drawn to logos and flashy pieces, and more interested in craftsmanship, value for money, or discreet luxury. After years of steep price increases, Dior appears to be bumping against a limit in what consumers are willing to pay. The combination of higher prices, unstable economy, and shifting taste means fewer big leather goods purchases, which negatively affects revenue. Internally, LVMH has acknowledged the challenge. In its 2025 earnings report, the company noted that profit from recurring operations fell sharply, a 22% drop for the group overall, driven mainly by the fashion and leather goods division. While not all of that loss is strictly Dior's fault, some comes from other houses. The pressure on margins will force tighter budgeting, fewer big investments, and more conservative production planning, which may affect new collections and luxury appeal. Dior's difficulties are compounded by brand-wide exposure across many markets. When global demand falters, the impact is felt widely because Dior does not rely solely on one region. With lower same-store sales, weaker wholesale performance, and rising costs, production, logistics, currency, the brand's previous growth momentum has stalled. Even iconic houses like Dior need to adapt. Rethink price strategies, invest in products that match changing tastes, and possibly tighten release cycles to avoid overexposure. That said, there is some hope for recovery. LVMH recently appointed new creative leadership at some houses, including moves intended to refresh design direction, more carefully calibrate prices, and perhaps target more value-conscious but style-aware consumers. For Dior, such changes may help restore relevance, but given the scale of the problems, any rebound will likely be gradual and need consistency. Lastly, is a brand that thrived on price as proof of worth. Now that tactic backfired, leaving it struggling to persuade anyone that expensive equals worth it. Number 1. Salvatore Ferragamo. Salvatore Ferragamo has seen one of the sharpest declines among established luxury leather goods houses in 2024 to 2025. The company's end of 2024 results revealed a net loss of 68 million euros, a major reversal from a 26 million euros profit in 2023. Its adjusted operating profit, EBIT, dropped to 35 million euros, down from 79 million euros the prior year. The 2024 full year also saw revenues fall by 10.5% to about 1.04 billion euros. These aren't small fluctuations. Ferragamo moved from profit to loss in a single year, underscoring the gravity of its challenges. The slide continued into 2025. In the first half of 2025, the company reported total revenues of 474 million euros, down 9.4% from the prior year at current exchange rates. Operating result, EBIT, swung negative with a loss of 44.1 million euros, and net income dropped to negative 57.5 million euros from a small profit the prior year. Direct-to-consumer DTC sales, typically the stronger channel for brand-controlled pricing and margins, were down 6.5%, while wholesale revenue plunged 12.6%. Regionally, the Asia-Pacific market, particularly China, experienced the steepest decline, about negative 9.3%. Europe, Middle East, Africa, EMEA, dropped negative 7.8%, and North America saw a smaller dip, negative 3.9%. These weak numbers across channels and regions show that the decline was widespread and systemic, not limited to one geography or format. Why did this happen? One major factor was weaker demand in Asia, which had for years been a pillar for global luxury growth. As economic uncertainty, tighter consumer spending, and shifting tastes took hold in that region, many buyers pulled back or delayed luxury purchases, hitting leather goods houses hard. Ferragamo's own management explicitly pointed to Asia's slowdown and a poor wholesale environment as key reasons for the drop. Another cause seems to be brand positioning and value mismatch. Ferragamo, like many older luxury houses, had invested in repositioning, including changes in creative direction and efforts to modernize product and brand image. But in a climate where consumers are scrutinizing price versus value, and where alternative brands, with likely lower prices, compete hard, Ferragamo struggled to justify its pricing. The drop in full-price sales and steep fall in wholesale suggest many buyers or retailers felt the value was no longer aligned with cost. Organizational shakeups followed. In March 2025, the company's CEO, Marco Gobbetti, stepped down after just over 3 years in charge as he failed to reverse the negative trend. The board, led by the founding family, named the chairman as interim head while the search for a successor proceeds. The company also announced a strategic action plan to revive sales and relaunch the brand, acknowledging that the current business model requires deep repositioning. Ferragamo has signaled caution. Short-term expectations are modest, and it expects pressure to continue until macroeconomic conditions improve and consumer demand for luxury recovers. The company is also trying to recalibrate distribution, product mix, and wholesale versus direct-to-consumer balance to rebuild margins and brand appeal. But as of mid-2025, Ferragamo stands among the struggling luxury groups, serving as a warning to other long-established heritage houses. The luxury sector's decline is not caused by a single factor, but by a combination of several issues. Many of these brands appear to be in the midst of a tough correction. Overpricing, overproduction, overexposure, and now the consequences. As consumers become more value-conscious, demand is shifting away from flashy logos and inflated prices. Brands that survive may need to rethink their approach. However, those that don't adapt may keep sliding. The luxury market is evolving, and time waits for no brand. If this breakdown changed how you think about luxury, let us know in the comments. Which of these brands was the most obvious to you? Do you think they have better chances in 2026? Drop your thoughts below. Hit that like button. Subscribe so you never miss our next deep dive into the hidden dynamics of wealth, status, and the brands desperately trying to capture both. Because in luxury, nothing is permanent.